Look, if you've been trying to buy a house any time in the last 4 years, you are probably completely exhausted. You've been sidelined by sky-high monthly payments, outbid by all-cash offers from people who didn't even look at the house, and frustrated by an almost total lack of inventory. It's honestly felt like an impossible game to win. But right now, a massive shift is underway in the real estate landscape, and we really need to ask the burning question. Is the housing market finally cooling down? I mean, is relief actually here?
Welcome to The Explainer. Today, we're diving deep into recent trends in real estate, interest rates, and exactly what all of this means for potential homebuyers. We're looking at some incredibly fascinating, real data from top market analysts, places like Redfin, Zillow, and Realtor.com. And you know what? They are all pointing to one central theme. We have officially entered what they're calling the Great Housing Reset. Now, it's not a crash, and it's not a boom. It's something entirely different, and understanding it is absolutely crucial to finally getting the keys to a new home.
So here is our roadmap for today's Explainer. Number 1, we'll cover the Great Housing Reset. Number 2, where prices are heading. Number 3, the interest rate equation. And finally, number 4, the 2026 Buyer Playbook. Let's get right into it.
Okay, Section 1, the Great Housing Reset. Moving from panic to preparation.
2026 is shaping up to be the most predictable market we have seen since 2019. We are finally, thankfully, leaving the pandemic market behind. You remember that era, right? Sub 3% rates, literally zero inventory, and sheer panic where you had maybe 15 minutes to offer 50 grand over asking. Well, now we're entering a phase of mid 6% rates, rising inventory, stable prices, and most importantly, logical buying. The chaos is finally draining out of the system.
And we have the data to back that up. According to Realtor.com's recent monthly housing report, active listings have increased 10% year over year. 10%. This actually marks the 27th straight month of inventory gains. So the really crucial takeaway here is that rising inventory is your absolute biggest advantage as a buyer right now. More homes on the market means you actually have choices. You can compare properties. You can walk away without the sheer terror that you'll never find another home again. And because of that inventory, we're seeing another huge shift, 78 days. That's the typical amount of time a home is now spending on the market, which is a solid bump up from last year. This is a game changer. It means you are no longer racing a ticking clock. You can actually go see a home on a Saturday, sleep on it, talk to your lender, go back for a second viewing on a Tuesday, and guess what? The house will likely still be there. A normal pace leads to thoughtful decisions and vastly fewer buyer regrets.
Real estate expert Jeb Smith really hit the nail on the head recently. He pointed out that 2026 is shaping up to be the most balanced, predictable housing market we've had in years. The market isn't falling off a cliff, it's just adjusting into a healthy phase. And if you are prepared, predictability gives you massive leverage. You finally get to make decisions based on math, not just adrenaline.
All right, moving on to Section 2. Where are prices heading? Normalization, not a crash. We really need to separate fact from fiction when it comes to crash myths. If you've been sitting around waiting for home prices to drop 30% across the board, the 2026 forecasts offer a bit of a reality check. Realtor.com predicts exactly 0% growth, totally flat. Redfin expects a tiny 1% bump, and Zillow is forecasting a really modest 1.2% increase. So they all agree on one major thing. National prices are incredibly stable right now. They aren't shooting to the moon, but with high homeowner equity and tight supply, they certainly aren't crashing either. We're looking at a true price plateau.
But hey, national averages can totally obscure local realities. So let's dig into the localized nuance for a second. Look at how things change depending on where you actually are on the map. The South and the West are actually seeing slight dips in median list prices, down 1.3% and 2.1% respectively. The Midwest is up slightly. But look closely at the Northeast. Even though the overall median price dipped 0.5%, the price per square foot actually rose almost 4% year over year. This is because buyers are fleeing to refuge markets, which pushes up the cost of available space in those inventory-squeezed areas.
And because real estate is so intensely local, your negotiating power shifts heavily by geography. When we look at the share of active listings with price reductions, it's pretty revealing. If you're buying in the West or the South, nearly 16% of homes have had their prices slashed. In slower demand metros, places like Tampa, Phoenix, and Portland, nearly a quarter of all listings are discounted right now. But in the Northeast, only 8.2% of homes are taking price cuts, so location really dictates your leverage.
Now, this price stability isn't just an American phenomenon. Data from international markets like Spain's highly sought-after Costa Blanca region shows the exact same trend. So, why aren't prices crashing globally?
Well, it comes down to the scarcity of available supply, active international demand, and incredibly tight rental markets that just keep pushing people toward home ownership. These global forces are putting a very firm floor under housing values almost everywhere.
Which brings us to Section 3, the interest rate equation, navigating the 6% reality.
This is the metric everybody watches because, let's face it, it dictates your monthly payment. Let's dive into this number right here, 6.43%. According to recent Freddie Mac primary mortgage market surveys, the 30-year fixed-rate average has hit this mark, which is actually down from the 6.6% and higher averages we saw last year. For a lot of sideline buyers, seeing rates step down into the mid to low sixes acts as a huge psychological green light. It's a signal that the worst of the rate shock is finally behind us.
And that trend is expected to hold pretty steady. Redfin is predicting that the 30-year fixed mortgage rate will average exactly 6.3% for the entirety of 2026. The big takeaway here is simple. Rates are not plummeting back to 3%. That era is over. But a stable, mid-6% environment provides something buyers literally haven't had in years: certainty. You can actually sit down and calculate your future monthly payments without the constant fear that rates are going to suddenly spike to 8% while you're out house hunting.
All of this data culminates in Redfin's core prediction for 2026, which is true affordability improvement. What does that mean? Well, because home prices are flattening out at roughly 1% growth and the broader economy is still seeing wage growth, 2026 will be the first time since the Great Recession era that incomes rise faster than home prices over a sustained period. It's basically a slow, gradual easing of the affordability crisis. Your paycheck is finally catching up to the housing market.
Let's wrap things up with Section 4, the 2026 Buyer Playbook: How to Win in a Normalizing Market.
So, knowing all this macroeconomic data, what should you actually do? Well, here are the 3 golden rules from market experts for this year. Number 1, know your actual monthly budget, not just the purchase price. Make sure you factor in taxes and insurance, which are absolutely rising. Number 2, build your real estate team early. You need a great agent and a solid lender lined up way before you fall in love with a house online. And number 3, this is crucial, do not wait for perfect interest rates. Listen, if you sit around waiting for a fantasy 4% rate to return, you'll just end up competing against 5 million other buyers who had the exact same idea, and prices will just shoot right back up. We're also seeing the return of something we haven't experienced in half a decade: normal seasonality. The calendar actually matters again. Think of it like this. In January and February, you have low inventory but highly motivated sellers. March through June is peak season. You get the best selection, sure, but also the most competition. That's when the year's price appreciation happens. By summer, buyers go on vacation, which opens the door for deals. And in the fall, homes sit longer, meaning sellers get very flexible. You can align your search perfectly with your own personal strategy now.
And this seasonal rhythm dictates the power you now hold. If a home has been sitting on the market for 60 or 90 days, you suddenly have enormous leverage. Remember in 2021 when you had to waive every single contingency just to get a callback? Not anymore. Today, you can negotiate the purchase price, you can ask the seller to cover your closing costs, you can demand repair credits after the inspection, you can even ask the seller to pay for a mortgage rate buy-down to lower your monthly payment. These are luxuries buyers have not had in years, and if you're in the market, you absolutely need to use them. So I want to leave you with this final provocative question. Are you prepared for the normal market? Look, the data is crystal clear. The panic is over, we have stable prices, rising inventory, and rates settling into the 6s. The opportunity is here, right now, for those who replace emotion with logic and preparation. So what's it going to be? Will you keep waiting on the sidelines for a magical crash that isn't coming, or will you use logic to capitalize on the great housing reset? The choice is entirely yours. Thank you so much for joining me on this explainer, and I will see you next time.